Welcome to Kitchen Table Finance, the podcast where we serve up bite-sized pieces of financial advice to simplify your money and your life. Join your hosts, David Shotwell and Nick Nauta, and let's get started.
Hey, Dave, how you doing today?
I'm doing great, Nick. How are you?
Fantastic. It's nice and warm inside, sunny outside.
It's about all you can say
about that.
It's sunny out there, and I hope I don't have to go outside and experience it.
Indeed. So we got a great show today. This is our quarterly market recap where we take a look at how we closed out 2025 and shed some light on what to potentially expect in 2026. But if our prediction show taught us anything over the last 3 years, we are not exactly great at that. But we do have some basic tenets that I think are helpful to think of in context of what the year looks like. So with that, Dave, why don't we start with how we ended up 2025?
Well, across the board, 2025 ended up very positive with what I see as two main lessons that really reinforce a couple of important things that we've definitely talked about here before, but that are also just part of our investment philosophy. And the first one being that you've got to be disciplined. Mm-hmm. And 2025, I think, illustrated this more drastically than other years in recent memory. And, you know, if you remember kind of the way 2025 unfolded, the year kind of started off okay, kind of, you know, everybody was a little tense about the change in administration and some things that were going on. But then by like March and rolling into early April, the markets were really roiled about tariffs and global trade issues. And we actually saw within a, 5-day span?
Yeah.
We saw a 6% slide at the beginning of April, followed by like a 9.5% rise within 5 days.
Yeah.
And so the lesson here, and then the rest of the year played out very positive. Sure. To the tune of over 17% returns on the Standard & Poor's 500. And so the main lesson there is discipline, right?
Right. Yeah.
If you had tried to react to the market drop in early April, you'd have been standing there empty-handed when the market sprang back and continued to rise from there.
Yeah, this chart that we're kind of referencing here that we'll put in the show notes is definitely illustrates that point quite well. But like you said, the January 1st to April 8th, down 15%, and then from April 9th to the end of the year, up 38%.
Yeah.
It was definitely one of those, the patient and steady investor kind of wins the day because there was a lot of things going on last year, and we saw the market do quite a bit of volatility involved with that.
We'd all have been much better off just walking away in March and coming back in like June.
Yeah.
And not, skip the hand wringing and the tense moments in between.
Yeah, for sure.
So that's lesson number one. Lesson number two, another thing we preach all the time is diversification.
Mm-hmm.
And that really in 2025 unfolded in two ways. The first being that for the last several years, everybody's been talking about the Magnificent Seven, the AI tech stocks, very narrow, large group of stocks driving market returns, right?
Right.
Like in 2024, you could have just bought any one of those 7 stocks and nothing else, and you'd have looked pretty darn good. And everything else kind of held you back, right?
Right, for sure.
And then, 2025, we have another really great year overall for the markets, but only 2 of those stocks in that group of 7 outperformed the S&P 500 as a whole. The rest of them actually lagged the market. Mm-hmm. And so, being concentrated in any one of those stocks probably would have hurt you in 2025.
Right.
So that's one aspect of diversification that we really saw reinforced. the other one, something you and I have like
finally
for years. Finally, owning international stocks made sense, right?
right.
And to the tune of, while the S&P 500 was up 17% for the year, just about every way you slice the international market was plus 30%.
Right.
Whether it's international, large cap, developed, emerging markets, we just saw stellar returns across the board and adding value to the portfolio at a time when the S&P still did very well. So it's relative value, but adding outperformance if you were diversified.
Yeah, I'm looking at this chart right now, my second favorite chart of the year. Don't you love January? The shifting tides, U.S. versus international stocks, just looking at the rolling 12 months. And it's been quite some time since we saw double-digit outperformance where international actually outperformed the U.S. by more than 10%.
Yeah.
It's double digits. But just looking at this chart and just going back in history, it's just, what it really just shows me is it's a crapshoot in terms of trying to determine, what is going to outperform during that time frame and what is not potentially. And so and that's why we believe in diversification of not trying to choose one or the other, or not trying to time who's going to be, in a superior position and hold everything. Because what usually happens is we get, similar returns with much less risk by diversifying across international and U.S. stocks.
Right.
And so this is a great illustration of just kind of the nonsense of trying to predict what direction this stuff is going to go.
Yeah. And who knows, how that's going to continue to play out. I thought it was interesting, a part of that outperformance in international stocks was driven by a weakening U.S. dollar, which makes international assets more attractive vis-a-vis U.S. investors.
Right.
But then also just good old-fashioned value, and the fact that the U.S. markets had outperformed for so long that money's going to flow to the lower valuation areas.
Sure. Yeah. It's, when we had talked about that before, just looking at the valuations, something had to give. And this year it was definitely international value that reaped the benefits of those.
Yeah.
So with that, Dave, let's kind of dig into our partners at East Bay put together our, looking at the glass half full, glass half empty, trying not to get too positive or too negative, keeping a level head when we look at markets, which I think is great. But we do like to bring these out to our listeners on the glass half full side. Why don't we start there?
Sure. Yeah. Well, a couple of these we've already kind of talked about here in our intro. It was a great year overall for both stock and bond markets.
Yeah.
It was hard. It was hard to invest in be disciplined and not make money last year.
Right. Yeah.
If you just, all you had to do, I think the Wall Street Journal, the first week of January, ran an article saying it like whatever you picked. If you were in cash, you did okay. If you were in short-term treasury bonds, you made money. If you were in stocks, you made more money. But like it was hard not to make money in 2025 if you stayed put.
Yeah. Well, it's interesting too, because looking at, the consumer sentiment numbers and how we are feeling in general as Americans, I don't think most people are looking back and going, man, that was a great year in the markets last year. Their experience is a lot different than what happens in the market, which I think is a good point to bring up of kind of how these things don't always work in the same way.
The old cliche that I know we've mentioned here before, that the bull market always climbs a wall of worry. Well, last year it was climbing a vertical wall of worry for a lot of people.
Right. Yeah. For sure.
It was rock climbing. It was boulder scrambling. So And point number 2 on the glass half full side, international stocks and being diversified actually added to global returns, and that's on the glass half full because it's good to see, from my point of view. Like just seeing the market do well because of this handful of international stocks over the last, or handful of tech stocks, over the last few years actually worried me in a way. Is the market really healthy when it's just that's driving returns? And now we're seeing kind of that broadening out where different names leading the S&P 500 and then international stocks and things that had been kind of out of favor are now finding money, finding investors to move money into them. So that's on the glass half full side for sure.
So we also, on the glass half full side, had a somewhat surprising, just looking at US GDP, the most recent reading was 4.3%, which actually surpassed some of the prior strong readings.
Right.
In general, GDP usually around that 2% range for the US. And so seeing these 3s and 4s last year was a little bit surprising strong. In terms of, growth in the US.
Yeah. We also, in terms of glass half full for the markets, we've seen the Fed lower interest rates, which makes corporate profits look better vis-a-vis discount rates. It makes borrowing easier and stimulates the economy. So we're seeing growth from that.
Yeah, in general, lower interest rates is something that the market celebrates. However, as we're going to get to on the glass half empty side, there's been a lot more that go into rates than a normal cut cycle. And so we've seen, that those have been scrutinized heavily and will continue to be as we get into this next year. But definitely in general, like you said, very good for markets when we go into the Fed lowering interest rates.
Right. But then there's the other side of the ledger, and we move to the glass half empty side. The unemployment rate has gone up to 4.6% during the last quarter. That's the highest it's been since 2021.
Yeah.
And so we've got this kind of conflicted story about the economy there, right? We've got really strong growth numbers. Usually when the economy is growing that strongly, we're seeing people get hired. Right? We're seeing lower unemployment, and instead we're seeing unemployment go up. So, anecdotally, at least what we're seeing is increased productivity. Companies are making more money and growing the economy with fewer hands on deck.
Yeah.
Which is interesting to see how that's going to play out.
Yeah, it's one of those too that, we see 4.6 and we think, wow, that's getting high. I mean, historically, not necessarily, but from where we came from the last couple of years, like you said, since highest level since
2021, but
trending in the wrong direction.
And I remember my macroeconomics professor back in the Stone Ages saying that anything below 5% was pretty much full unemployment. I don't know if that's still the rule of thumb they would use, but that was in the early 90s. And, anything looked better than what we had seen in the 80s. So,
definitely a trend to continue watching, though.
For sure. And then the other gauge that the Fed keeps their eye on that goes with unemployment and GDP growth is inflation. And it's not as bad as some people had thought it might be, but it's proving, I think Mario's word for it is stubborn.
Yeah.
Yeah. Sitting at 2.8, and the Fed would actually like to see it at 2%.
Yeah, it's definitely one of those, it's going back in the right direction, but there's a lot of concern over, how much of this it continues to be stubborn. Are tariffs going to continue to increase it? And then also looking at, if you peel back some of the inflation onion of what prices are doing, there's a lot of prices that people pay close attention to, like groceries that have shot up quite significantly.
Right.
Where, I think the price of eggs, which, other than a couple of years ago, was never really all that important or on anybody's radar until they spiked up, but are actually at like negative 12% in the last year or something crazy like that. But groceries in general are up. Gas remains pretty low. I'm not sure exactly what some of the other ones are. So it's always one of those where, we're at 2.8. It's higher than we'd like it to be, but if you parse that out, there's some things that are affecting other, people, maybe some of our listeners in different ways.
Yeah, inflation is always a tricky subject because we feel it at the grocery store, right? But then, when they're measuring inflation, my favorite example is televisions, and I just recently had to buy a new television over Christmas, and wow, I mean, the television that we were able to get would have probably been $10,000 like 15, 20 years ago,
Yeah.
right? And it was not that much. It was not anywhere near that much. They're almost just like my cell phone costs more than my television.
Yeah.
And it's like, wow, what this thing can do. And we forget that like, while we're paying more for oranges and apples and eggs, some of these other things that we still use, but we don't buy very often, have actually like come down significantly, or the computing power in general, So inflation is always a fun topic, because it's always, what did I pay at the grocery store yesterday? Not what happened overall at the gas pump.
Well, it's definitely not going away this year either. So something we definitely want to keep an eye on.
And, with this frigid January Michigan weather we're dealing with right now, there's only one way natural gas prices are going to go at the moment. So,
Indeed. This next one is one that we've actually talked about, where 5 of the Magnificent 7 stocks lag the S&P 500,
right?
Which we talked about a little bit. So
it's so interesting to see how these things shift, because in 2023 and a lot of 2024, it was, why should we own anything other than NVIDIA and Apple and Alphabet and Microsoft? And then you look at this chart, and yes, Alphabet and NVIDIA still outperformed the S&P 500 significantly. So if you picked those 2 out of the 7, you look fine. But Microsoft, Meta, Tesla, Apple, Amazon all lagged the S&P 500 significantly.
Yeah.
It's an interesting conundrum.
For sure. One of the reasons why we don't select individual stocks, we just buy the S&P 500, right?
That's right.
Takes the guesswork out.
Yep. Plain vanilla.
And then this last one, I think we can just put it on bold and leave it here forever, it seems like. But expanding geopolitical conflict to end the year.
I feel like we should have spinners in there, like Middle East, or, this, Central America this time around. And that's always going to be there. There's always going to be something to be concerned about internationally, for sure.
Yeah, for sure. I want to touch on this because you and I like to joke around on this podcast about the death of the 60-40.
Yes.
The 2025 return of the 60-40.
Long live the 60-40.
Measured by the MSCI All Class World Index and the Global Aggregate Bond.
Yes.
It was up 15.1% in 2025.
Yes.
I think most people sitting in the 60-40 would take that, right?
Yes. Yes. Well, if you look at that on a risk-adjusted basis, right?
Yeah.
So you took, I'm making up numbers here because I don't know exactly, but you're taking about 2/3 of the risk of the S&P 500 in terms of the volatility that you have to deal with when you're 40% in bonds. Yet in 2025, you were within 2% of your risk-adjusted returns when everything has been good. But boy, that kind of getting that kind of performance with less risk is really what an investment advisor dreams of. Right.
For sure. With that, Dave, let's take a look here real quick at just kind of the outlook for 2026, what some of the potential risks are for the market and the opportunities. Just looking forward here. We'll start on the risk side, if that works for you.
Yeah. So fiscal deficits and debt. We've had a new tax bill over last summer.
Yeah.
And it didn't do anything to fix the deficit. That's for sure.
Not.
We're seeing spending continue to rise, federal spending continue to rise, and federal debt will continue to balloon as taxes overall are going down as a result of that bill.
Right.
So, at some point that becomes a problem, right?
For sure.
And there's lots of debate amongst very, very smart economists. I'll leave the politicians out of it. They like to debate it, but the economists are the ones that are trying to solve that problem. Like, how much debt is too much debt? What is sustainable? And it all comes down to growth, right? If your economy can continue to grow faster than what it costs you to service that debt, then everything keeps chugging along. But at some point, that can catch up with you, of course.
Yeah, we've kind of seen it play out a little bit here in the geopolitical conflicts, which are on our list here of potential risks as well, where we're kind of in this, economic warfare situation, if you will, with tariffs and trying to economically force people to do what we want them to do.
Yeah.
Without getting into too much political, like you said. And what we're potentially seeing is countries wanting to divest from some of their U.S. Treasury holdings. Now, the interesting part is it's not like they can just go and sell them all. Well, they could, but it would probably do them more harm than
right.
It's
it's the financial equivalent of the nuclear bomb, right? It's mutually assured destruction.
Right. But if they then decide, like, okay, we need to divest over this, and we need to do it over the next 30 years, and we need to stop buying as many of them and find a different reserve currency, like that can play out slowly over time and have some major impacts in terms of, how we're able to maintain that debt and what kind of level we can even sustain.
Right. The Fed can lower short-term interest rates all they want, but if nobody wants to buy 10-year and 20-year U.S. Treasury bonds, it's not going to matter.
Yeah.
The rates will remain high until people buy them, or will continue to rise until people buy them. And we've already seen some of that diversification amongst global banks. And, I'll get in over my head pretty fast if I try to go into detail on this, but that's a lot of what we see with the price of gold over the last few years. Lots of different reasons, but supposedly like the sanctions on Russia were a wake-up call to a lot of countries, that a lot of global bankers, that they need to diversify away from U.S. assets so that they don't have that kind of problem. If you were the investment advisor, you'd be talking about diversification just like we talk about it with stocks and bonds with our clients.
Right.
So
for sure,
next on the potential risk side, muted labor force growth and higher unemployment. And, with like kind of a side helping of fears about AI. And is this situation where we're seeing companies become more and more productive with fewer and fewer people?
Right.
Is it the beginning of this huge change where we just don't need people doing things? And how is that going to play out in society? So that's definitely a risk.
Yeah, in general, when technology like this is incorporated, there is this kind of, usually you end up with more jobs or higher paying jobs or better jobs, but it's not always a straight transition, right? Johnny's not going to get a promotion because AI is doing his job.
Yeah.
Johnny's going to have to figure out how to work with AI so he can get a promotion. Yeah. And there's that kind of that lag in between for a lot of this stuff.
And
so
not everybody's able to make that adjustment. It's going to be interesting to see how it plays out. And I think part of it right now is all of those potential new jobs are all theoretical, right? Like nobody really knows what they will be or how they're going to look.
Yeah.
So it's particularly scary to, you can't just say, well, this particular job is going to grow because of this. And and I think it's an interesting mindset shift for people that have always, over the last 50 or 60 years, it's been all about finding tech jobs and, high level service industry consulting jobs. And those are seem to be the ones most open to disruption from AI. So it changes people's paths to wealth in a way that I think people are not mentally ready for yet.
Mm-hmm. Yeah. Potential for more government shutdowns.
Yeah. What do you know? They still can't seem to get along.
So long before it comes back around.
Yeah. I don't know that there's ever going to be a fix for that. In our binary party system with no real incentives for them to get along right now.
Right.
It's not likely to change anytime soon. So, it's interesting. It's been pretty rancorous, right? And like last fall, it ended up being the longest shutdown, I believe.
I think so. Yeah.
It either tied or
It
was
up there.
longer by a few days. So those situations are getting worse, maybe, or elevating, or the rhetoric around it. But the market is kind of like, well, yeah, this happens every 18 months or
Right.
oh well, kind of shrugged it off in a way.
Yeah, for sure. So we talked about geopolitical conflicts, and I alluded to this earlier, but one major potential risk is the independence of the Fed. And we've seen that. We have a court case going on right now with the president trying to essentially fire a Fed chair. More for political reasons than what actually transpired. And so the problem with that is when the Fed loses independence, it potentially has dire consequences, because if people don't believe that the Fed is acting independently, then it's this self-fulfilling prophecy of, if we believe that if the Fed doesn't have independence, so we should expect more inflation, we make decisions based on the fact that we think that there's going to be inflation, which leads to inflation, right?
Right. Because you have short-term decision-making then based on the regime in power and their particular needs in the present moment, when economic decisions made today are going to ripple through the next 20 years or longer. And or to put it another way, imagine how the economy would gyrate if every 4 years we wiped the slate clean with the people making the decisions on monetary policy.
Right. Yeah.
And knew that they were just partisans making those decisions.
Right.
Yeah. It's interesting. I'm a little bit of a constitutional nerd, and the Constitution allows for 3 branches of government, and you can make the argument that none of it was meant to be outside of Congress or the executive. And so it's going to be interesting to see how the Supreme Court handles this going forward. But I look at it and think, I don't think James Madison envisioned complex macroeconomics on the scale that we deal with in the 21st century. But there may have been a fourth branch of government in the Constitution. But
that's a great point. So enough about risks. Let's talk about what opportunities are going on in 2026. Because and the interesting part of it, a lot of those risks were actually playing out in 2025, and we still had a great year. So there's always risks out there. But there's also opportunities, which is why we are investors and long-term investors in that. And the biggest one, and we've talked about it before, AI infrastructure build out with more adoption. What does that look like as we're starting to get more data centers online and more computing power and more useful AI tools? How does that revolutionize the companies that we invest in?
I don't pretend to be a techie at all anymore. There was a time I could make my Apple IIe do just about anything back in 1985. But some of the things you and I have played around with in our day to day here with, it's just mind boggling, the things that are all of a sudden available that 5 years ago would have cost us $100,000 to build our own solution. We can do in 20 minutes with AI exactly the way we want it. And it's just amazing. So I feel like we've only scratched the surface of what that can unlock for, the economy, and the potential is beyond my imagination right now.
Yeah, for sure. Other opportunities, we talked about this, the global investment uptick, reduced trade uncertainty, and getting, hopefully some certainty around trade and tariffs.
Some consistent policy would be.
Strong consumer spending. This is interesting because we've continued to see this decrease in consumer sentiment, but usually that's a warning sign of maybe consumers will stop spending. But it's
So
almost
far.
as if we don't believe anything that's going on, at least as it relates to our checkbooks.
Yeah.
Because we all continue to spend at a robust pace.
Yeah. Could just be retail therapy. It's hard to tell. But, but whatever it is, it's definitely stimulating growth despite everybody proclaiming to be in a rotten mood. So,
right. Yeah.
We'll take
and
it.
then potentially lower Fed funds rates. We've seen the needle move on this a little bit, but I think the last time I looked, there was pricing for 2 to 3 rate cuts in 2026. But that's always an estimate on what they think will happen. So lots of things going on with the Fed, like we talked about, but we should potentially see lower interest rates starting next year.
Yeah.
So some reasons for optimism, which we love.
Yes. Yeah.
And then we're just wrapping up like we always do, Dave. There's pros and cons, there's risks, there's opportunities, which is why financial planning is a process, not an endpoint. We are long-term investors, and we want to remind you to focus on your long-term goals and objectives. We could go back the last 100 years and come up with a list of risks and opportunities. And sometimes the risks would outweigh the opportunities and we'd get a bear market. But most of the time, the opportunities outweigh the risks, which is why we see long, robust growth. We talk about long-term investing.
Yep.
So just a reminder that we're in this for the long haul, right?
Well said. Well said.
And with that, if our listeners have any questions, feel free to shoot us an email at info@srbadvisors.com. Love hearing from you. Dave, until next time.
Thanks, Nick.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.